Welcome to Subramani. When you talk to a fund manager and you ask for some comments on some of the shares that are there in his portfolio, one word which you hear, which does not make me very comfortable, is the fund manager saying, I am comfortable with this share. Because I do not know from where the comfort comes. Does the comfort come from the process of selecting the share, or the broker who hawked it to him, or from the promoter? I do not know from where the comfort comes, because when you take a little risky decision, you can't be very comfortable, right? You can't be very comfortable taking a decision of climbing a mountain. You can't be comfortable with that decision. You may enjoy the trip, you may enjoy going up the mountain, coming down the mountain. That's a completely different thing, but you cannot be comfortable. Largely, it says that, it means that you checked out all banks and then you say, no, let us stick to HDFC Bank. And I'm comfortable with this position. Here you're largely saying, look, everybody else is buying HDFC Bank, so if something goes wrong with HDFC Bank, I won't get blamed. The whole ecosystem is buying it, so I'm sure RBI will take some action, so that's okay. So let me put 4% in HDFC Bank or 3% in HDFC Bank based on the weightage in the index. Will that person be as comfortable buying something which is not so well known, say an Equitas or Cholamandalam Finance? I'm not even saying they are comparable, because one is a real large cap bank, the others are NBFCs. Equitas is of course a small bank, so they are not really comparable, but I'm just giving an example. So comfort, the question for the investor to ask is, from where does this comfort come for the fund manager? Because if the fund manager goes through a process of collecting a lot of data, information, analyzing, meeting the analyst, meeting the promoters or meeting the employees there, etc., and then takes a tough decision, it's not going to be comfortable. Then he's going to be, or she's going to be on her toes, looking at what is happening on a quarter to quarter basis and saying, okay, this quarter result is so good, the price has gone up, the PE is adjusted up, so let me sell off a little bit of shares. I'm reducing my discomfort, I'm not increasing my comfort. I'm saying, okay, I'm holding a very huge position in this, so let me sell some shares. The price has gone up, so let me book some profit. I am reducing my discomfort. So I don't know how you look at fund managers when they say I'm comfortable with this. So I am comfortable with this also reminds me, I don't remember which author did this, but comparing a bunch of animals like say deer or antelope, which are in an African forest, and they're all eating grass. Here you're saying, I'm very comfortable in the middle of the herd, because I know if a lion were to attack, the guys on the side are likely to get attacked first, right? So they would be taken out, or they would have claws or lion claws on their body, right? They've escaped. But the chances of you being attacked are very remote, because there are few near you, the few ahead of you, few beside you, so chances of an animal, of a lion reaching you is not there. So that is what I feel somehow about comfort, because comfort means it means you're not getting the juiciest grass, right? It's already trampled upon by another 1,000 animals or 500 animals, whatever, depending on the size. And you're saying, okay, I'm comfortable eating that grass. I don't want fresh grass. I don't care. I don't want to go out and be a loner. I will buy HDFC Bank. I will buy TCS. I can't go wrong with TCS and HDFC Bank. Why would I go and stick my neck out for something else? Now, if you are an investor who wants a large cap fund where he does not take any risk, you might as well go to the index. If you want a small cap fund, I might argue that in a small cap fund I don't want risk, because there is anyway risk because of it being a small cap. But in a large cap, I want a very concentrated 10-12 share portfolio, not even a 30 share portfolio. I don't want the index. I want a 12 share portfolio where you will deliver results to me, and I am willing to take risk because I know these are good quality balance sheets, etc. So I will have a concentrated portfolio. Again, it can't give me too much of comfort, because I know that I am taking a higher risk. I have to get good returns. So if I have invested money, maybe I will keep booking profits to reduce the discomfort, right? So comfort in investing does not pay well, right? So the most comfortable investing has to be index funds. doesn't pay as well as say private equity. Private equity is very uncomfortable. Mostly after you make the decision, you are very uncomfortable having made that decision, but that gives you the highest return. Of course it takes the highest amount of risk also, because one might give you a 7,000% return and two may give you zero return, right? So on an average it might even out, but largely I'm not very comfortable using the word comfort. If you want a high risk portfolio, you're better off going to PMS than hoping to find a high risk portfolio in mutual funds, because mutual funds are trying to cater to the average person who is comparing the mutual fund to the index. He's only comparing it to the index. He does not want some great alpha or anything like that. If you want alpha and you are willing to compromise and say I want a 12 stock large cap portfolio, it is possible for somebody to build a large cap portfolio which will be very focused and which is bound to lose money on many years and gain substantially on other years, right, during other times. So over a 5-year period you may get a very good alpha, but for 3 years or 4 years also you may be doing very badly compared to the index. So if you are not going to panic by that, then only then should you be looking for a portfolio manager who is taking a higher amount of risk. Is it worth taking higher amount of risk? I'm sure it is worth taking a higher amount of risk and not worrying about things like mean and standard deviation and things like that. So if I give my money to a fund manager and say here is the money in 2023, I will look at you only in 2028 to exit or to invest more, but for 5 years I am going to look at the portfolio. I might discuss, I might warn you against some company which is not doing well or where I know the promoters. That's a completely different thing, but overall I'm not going to I'm not going to judge you on the concentration risk or on saying why did you buy so much of IT and why not so much of banking. I'm not getting into all that, right? So I'm allowing you freedom. Is it possible to build a portfolio like that? Yes, perfectly possible. Don't look for high yield shares, just look for high growth shares in the A group, which you are, in your definition is a high risk portfolio. If you are trying to build a high risk portfolio, just go and do it. It is possible to do it, but you may not want to take that risk in a small scale fund, a small cap fund. So to quote Warren Buffett, be fearful when others are greedy and be greedy when others are fearful. It's very easy to say but very difficult to do. But in a booming market where equity is doing well, it is easy to invest. It's not very difficult because you invest the money and then you, let's say you're 24 years of age, you start investing and in 2 months, 3 months, your father has never invested, in 2-3 months you see a 4%, 5% kind of a return. You go and tell your mom, see, I told you this is the kind of money I'm making. That kind of adrenaline rush is very useful for you to be an investor. The chances of making money in a bull market where everybody is investing and everybody is buying the same HDFC Bank, Asian Paints, Pidilite and what have you, chances of you making money is reducing. Maybe then you're better off with an index fund saying whatever happens to the market will happen. So taking risk in a booming market is going to be very easy to take risk, which you should not be taking. In the market which is down, like when the market is, say, let's talk about the Sensex being at say 63,000. At 63,000 it looks hunky-dory and you want to say, wow, now I think market is going up but only it can't come down and things like that, and then the market starts coming down, right? Any of these things can happen. How do you react to these things? How comfortable are you with this kind of a situation, right? That's the question to ask. And will you get higher returns? Will you get lower returns? When everybody is buying equity, the chances are you will get lower returns. When everybody is shunning equity and saying equity, you don't even mention, I lost so much. When there is so much anger in the market, chances are when you buy, you will get better return. But what happens in the bull market is everybody is comfortable with everything. Oh, I'm very comfortable with this small cap fund. I'm very comfortable with this small bank. I'm comfortable with this big bank. Everybody is comfortable with everything because they think, oh, last month market gave 8% return, this month market will give 7% return or something like that, right? So that's the challenge. The challenge is when you are comfortable, it means you should not be taking risk perhaps. I don't know. The question is from where are you getting the comfort? And if you're getting too much of comfort, understand the client is not paying you for being comfortable. The client is paying you for going out of the box, thinking, buying, and generating a good return over a long period of time, right? Don't worry about quarter to quarter alpha and year to year alpha. Over 5 years, if a fund manager can give you good results, that's the way to look at fund management